Welcome to the last step of the new IFRS15 revenue recognition model. So far, we have learned how to identify a contract, its performance obligations, how to determine the transaction price, and how to allocate the transaction price to each performance obligation. We are from Kong Lim and Partners, Chartered Accountants of Singapore, and a member of JHI and Task. In this episode, we will go through Step 5, the last step of the revenue recognition model, recognizing revenue when or as an entity satisfies a performance obligation. First, we have to identify when exactly is a performance obligation satisfied. A performance obligation is satisfied once the entity transfers the goods or services to the customer, thus giving the customer control of that asset. This brings us back to what was explained in episode 3. Control of the asset, which is a satisfied performance obligation, can be passed over a period of time or at a point in time. As a quick recap, performance obligations satisfied over time would include monthly magazine subscriptions, building of a shopping mall where shops are added at different time frames, and specialized goods or services. On the other hand, performance obligation satisfied at a point in time is one where the entity has immediate right to payment for the asset and control of the asset is handed over to the customer upon payment. In order for a performance obligation to qualify as one that is satisfied over time, one of 3 criteria must be met. Number 1, the customer simultaneously receives and consumes the benefits as the entity performs, or number 2, the entity's performance creates or enhances an asset that the customer controls as the asset is created, or number 3, the entity's performance does not create an asset with an alternative use to the entity, and the entity has enforceable rights to payment for performance complete to date. If none of these criteria are met, revenue cannot be recognized until control of the goods or services are passed to the customer at a point in time. This happens when the following are transferred and fulfilled: the immediate rights to payment, the legal title of the asset, physical possession of the asset, risk and rewards of owning the asset, and customer acceptance of the asset. Let's look at an example. Customer A engages a construction company to build a home on a land that customer A owns. The construction company agrees to build the home on January 1st and completed the building in November of that same year. Should the construction company recognize revenue over a period of time or when the control is passed to customer A? Let us first look back at the factors that contribute to a performance obligation satisfied over time. Number 1, the customer simultaneously receives and consumes the benefits as the entity performs. For this first factor, the customer probably would not live in a home that is not completed. Number 2, the entity's performance creates or enhances an asset that the customer controls as the asset is created. Since customer A owns the land, he controls the asset as well. Therefore, the construction company would recognize revenue over time, in this case, 1st of January through November. If, however, the construction company themselves own the land that they are building a house for customer A on, the outcome changes. Since the first 2 factors are now not applicable, let's look at factor 3. The entity's performance does not create an asset with an alternative use to the entity, and the entity has enforceable rights to payment for performance complete to date. Because the construction company owns the land, they could therefore sell the built house to someone else should customer A decide not to purchase it. In this case, The construction company would have to recognize revenue upon completion and sale of the house, which is at a point in time. We hope that our video series has helped you understand IFRS 15 better. Do stay tuned for our upcoming videos with more examples on each step of the new standard. Thank you for watching.